Here is part 2 of our chapter 11 video lecture, where we're going to discuss special situations in regards to capital gains and losses. For example, we know that if you sell investments, you're going to realize a gain, and the gains are going to be taxable, and hopefully the losses will be deductible. But how about if you never sell the investment? You just hang on to it. If it decreases in value, you cannot take a loss until you sell it. But let's say you never sell it and it goes all the way down to a zero value. In the year it turns totally worthless, that's the year you can claim a loss. Of course, zero sales price minus your adjusted basis will equal a loss equal to that adjusted basis. Now, if that investment has some value, even $1 at the end of the year, you still cannot claim a deduction until it is totally worthless. Okay, only then you would use December 31st as the date of sale, claiming again a zero sales price, minusing out your adjusted basis to get a loss, probably a long-term capital loss deduction. Okay, that's the rule for worthless securities. Let's take a look at the next rule called Section 1244 stock. So a stock investment is a capital asset, resulting either in a capital gain or a capital loss. But to motivate people to develop and raise businesses, this is a rule that allows investors to deduct an ordinary loss when they have a small corporation. Small meaning that typically they're an original owner and the capitalization or the total investments at the start of the business, really the start of the corporation, is $1 million or less. And then in the year that the stock is sold at a loss, or again it's totally worthless by the end of the year, the taxpayer can claim an ordinary loss up to $50,000 for unmarried or $100,000 for married filing joint return. Again, the motivation here is for people to create businesses, small businesses. You should probably get some legal work done when you first incorporate the business. And in the charter or articles of incorporation, you want to affirmatively state that the stock you're issuing is Section 1244. Again, it's typically going to be only for small businesses because of this $1 million initial limitation for the size of the business. Let's look at our next special rule that deals with selling between related parties. If you remember back in chapter 10, our last chapter, when we had sales between related properties and had a loss, the loss is not immediately deductible, but can be used by the buyer, the related buyer, if that related buyer eventually sells the property at a gain. But here, the initial sale results in a gain. And if that gain is, if the sale is to a related person, meaning within your family or a business you own at least 50% control, then the gain is going to be taxed not as a capital gain, but taxed as ordinary income, taxed at regular tax rates. The reason for this is that possibly the higher price item to the buyer can be used at a better tax rate. Yeah, like we'll talk about depreciation in next semester, and get a better deduction than the seller here that has to report taxes on their gain. Okay, again, that's a sale between related parties, resulting in a gain here in chapter 11. Let's look at the next rule, where we have land being bought. And then because the land is so big, what we want to do is subdivide it and sell smaller lots. The general rule, of course, is land, if it's not used in a business, is a capital asset resulting in a capital gain. And if you held the property for more than a year, you're going to be taxed at the lower capital gain rates. But if you start subdividing your property, chopping it up into smaller pieces, and then you're selling each one, this looks like more like a dealer where you're buying and reselling, yeah? Buying and reselling. Well, if you've held the property for at least 5 years, or you inherited the property, and now you want to subdivide it to make it more marketable, you can probably sell up to 5 pieces, units, and get a capital gain rate on your profit. But in the year you sell the sixth lot, the sixth unit, any unit sold in that year and future years, you're going to have to pay regular ordinary tax rates versus the lower capital gain rate. Okay, so if you're in this situation, you probably want to time your sales, yeah, so you don't have that sixth one probably taxing the earlier sales as ordinary rates. Let's look at another situation here called non-business bad debts. So in the case, let's say, of a bank that is in the business of lending money, and they know because they lend so much, some of their borrowers will not be able to pay back their loan. So they are now able to deduct what we call a bad debt expense deduction. But for most of us, we're not in the business of lending money. Yeah, we're non-business, but we do lend money, let's say, to friends or family, which you shouldn't do because if they don't pay you back, they'll interfere with your relationship with them. But if you do, you gotta treat that loan like a business loan where you make them sign a promissory note promising to pay back the money you lent with a fair interest rate being charged, with a due date, with a set term, yeah, they have to pay by, just to treat it like a business. Otherwise, if you don't treat it like a business, it's considered to be more like a gift that they don't have to pay back. But if you do expect them to pay back, you gotta treat it just like a business. But because you're not in the business of lending money, and if they're not able to pay back any money, you can claim what we call a non-business bad debt. And for tax purposes, it's treated as a short-term capital loss. Yeah, to the extent you don't get back any of that lent money. But you have to make sure you treat it just like a business loan, a promissory note, charging interest, setting a due date. And if you still have to report anything that you do collect as proceeds, yeah? And what you don't collect out of that initial loan is deduction. Treat it again as a short-term capital loss. Back in chapter 10, we saw when there was a casualty, like a fire, an accident, a flood, and it resulted in a loss. Only losses incurred in a national disaster area declared by the federal government could be claimed, could be deducted, yeah, as a loss. But let's say that maybe you have a gain on a theft or casualty because the insurance proceeds you collect from the insurance company is larger than the adjusted basis of that property. And of course, again, you're going to be paying taxes. There's some exceptions. If you reinvest the proceeds into a replacement property, you can defer the gain. But let's say you don't do that. If you remember, you cannot claim a loss if it's not related to a national disaster, except you can reduce this gain for those undeductible losses we've talked about. And only then, if you still have any extra gain, that gain is probably going to be a capital gain. Yeah, tax at capital gain rates. let's see. I think that's it for this video, this short video. We're going to be covering business gains and losses when you sell business property. Again, next semester when we talk about business taxation. Okay, so we have one more video for this chapter 11 talking about the tax forms and schedules you have to fill out to report the gain or the loss. Okay, so take a look at that last video.